Welcome to the Art of Securing a Premium Valuation. This session is presented by EdgePoint. Let's meet the panelists. First, Art Anton, former CEO, SwageLock. Next, Mark Jones, partner at River Associates. And your moderator today is Tom Zucker, founder and president of EdgePoint Capital. Tom, the virtual stage is yours.
Good morning and welcome to the Art of Securing a Premium Valuation. I'm Tom Zucker, president and founder of EdgePoint Capital, a national M&A advisory firm focused on helping privately held business owners through complex transition events. For the last 2 decades, we've been trying to give thoughtful advice and insight to our clients, not by opinions or guesses, but rather with facts. So as we prepared for the session today on the difficult topic of how to get a premium valuation, we thought a survey was necessary. So we conducted a survey of 200 serial acquirers, family offices, private equity, SPACs, independent sponsors, and we asked them, why do you pay a premium valuation? The insights were really revealing, and today's conversation is going to highlight some of those observations. But like with everything, it's only part of the story. So today we bring 2 seasoned professionals to the table, Art Anton and Mark Jones, to augment the survey results and provide some of their insight. So with that said, I'd love to introduce Art Anton, have him give a brief background on himself, and then Mark Jones.
Thank you, Tom. Pleasure to be here. Thank you for having me. So my name is Art Anton, and my background is such. I was with Ernst & Young for over 20 years. I got to work with Mr. Zucker here. I was a partner for 10, did manufacturing and financial services, and then I joined a company called SwageLock, which is a privately held $2 billion manufacturing company that manufactures mostly in the U.S. but sells globally. Over half their sales are outside the U.S. I went there as CFO and then became president and CEO in 2002 and retired or left and started my next career at the end of 2019, right in the smack of hitting COVID. So it's a pleasure to be here, and I hope I could add some insights, and I look forward to working with everybody. I also am on a couple of public boards, chair of University Hospital Healthcare Systems in Cleveland, and I work with about 10 or so private companies. Thanks, Tom.
And how about yourself, Mark?
Thanks for having me, Tom. It's a pleasure. My name is Mark Jones. I'm a 26-year partner with River Associates. We are a lower middle market private equity fund based in Chattanooga. Started in 1989, so I've been doing it a long time. Currently investing our 7th committed capital fund, which is a $285 million fund. We've made now, I think we're up to 103 investments over our history, a mix of both platform companies and add-ons. Again, focused on the lower middle market, very generalist in nature, but a lot of B2B product companies. Pardon me, I'm on a Zoom, nothing like a cough. So you'll see a lot of niche manufacturers, some distribution businesses, some business service companies, and these businesses have been located all across the country and into Canada. So generally speaking, these are single-digit EBITDA companies upon entry, and our goal is to make them into double-digit EBITDA companies and ultimately exit to both financial buyers and strategic buyers.
Now that's great. Thanks for the background. Kind of with that said, Mark, not surprising to me, but one of the biggest response that came back from the survey that management, people, leadership is one of the most desired aspects from an acquirer and one that usually obtains a premium valuation as a result. Love to get your insights to that finding and love to hear your view on what makes a great management team.
Sure. Admittedly, we don't always have a complete team in lower middle market companies. Again, these can be $25, $30 million revenue businesses that are often founder held, privately held. You've got an entrepreneur at the helm. You may not have all the disciplines covered. In an ideal world, we would have a CFO, a COO, a VP of sales, succession to the CEO, but it's certainly not an ideal world. So in many of the platform companies, we do have to augment these teams. It's not uncommon that we have to add a CFO. Maybe there's a controller in there who is not used to dealing with lenders in a leveraged environment. So that's a very, very common add. Augmenting the management team is one of the first things we do, because ultimately, if we're going to pursue a buy and build strategy and go seek strategic acquisitions, you need a complete team to do it. So we want to have all the disciplines filled with good people, with seasoning outside of the target company. That's critical. And I would say the other things that are hard to assess are somewhat intangible, and they're tough. They're tough in a process, a sale process where you have limited face time with these people. So we try to get as much as we can. But what we're trying to assess is, what kind of partners will these people be? Are they ethical? Are they transparent? Do they mind working with a private equity board? What are the team dynamics? Is it driven by one? How are the decisions made? Is it a collaborative team? So those are the types of things that we're trying to assess again in a limited interaction phase.
That's great insight, and those are often hard to find qualitative elements. So thanks for the insight, Mark. The second thing that was really interesting about the survey is the ability to find a differentiated product or service. Now, Art, from your role from the private equity space that you operate in and your role at SwageLock, I'd love to get your insight as to your view of know-how, intellectual property, kind of that moat around a product. What's your view of that and how it impacts value?
Yeah, thanks, Tom. And like Mark, well, I do a little part-time work, Tom knows, for a company called MCM Capital here in Northeast Ohio, which sounds like has very similar characteristics to Mark's company. So, at SwageLock, we had a lot of patents, and proprietary products was really what made us tick. So in a valuation perspective, that is something that I look pretty heavily for. It typically would line up that proprietary products and know-how should translate into higher gross margins and higher EBITDA margins. And of course, you'll typically will have to pay more for that. But I think, as you say, building that moat and being able to operate in that space really gives you some competitive advantage. So I think that's an important aspect. At MCM because they operate what they define as the micro-cap space, sometimes they have proprietary know-how, but not products. They might be, quote unquote, a job shop or contract manufacturer. So they're look pretty heavily on their processes and can they differentiate their processes, which sometimes is a little harder to get a handle on. You can go have somebody read a patent for you, but know-how takes a little bit of a different twist. So important characteristics for sure.
And as you look at the world of, go ahead, Mark, please.
Well, I was just going to add, I totally agree his comment about the gross margins, and just to maybe quantify that a little bit. When we see a business, for example, that has gross margins less than 20%, it tends to indicate that it's probably a commodity item or in a very competitive marketplace where the company has very little pricing power. So we don't gravitate towards those opportunities. The other thing that I would add is we've invested in a few businesses where there's a high cost of failure associated with their products. So in that case, people are willing to pay more, and that's a good type of business. People are not as focused on price; they're much more focused on performance.
Yeah, that's a great point. And it's difficult whether you spend the money in advance of a sale process to memorialize or protect your intellectual property, or you go through the sales process with know-how. Depending on how small the company is and the cost associated with it, that becomes a difficult preparation discussion for business owners to deal with. It was not surprising to me when the survey was tabulated that management and differentiated products and services were the two reasons why premium valuations were paid. The part as we begin to do thesis of who the right buyer is for the business, it's a very thoughtful piece of work that EdgePoint as the investment banking firm will do. And of course, the logical answer is help find for me that ideal strategic buyer that can take out layers of cost, buckets of synergies, and that should lead to a higher price. Somewhere between those very simple words and the ability to tell a story, the ability to have the relationship, to pick up the phone to a multi-billion-dollar strategic acquirer and know why they're acquiring this business and how it fits in. Everyone is time starved these days. So that storytelling capability is absolutely critical. I'd love to talk specifically, maybe, Art, about a few of your acquisitions. I know the Mansfield Screw and the high-level acquisitions that you did, those were kind of in-market deals from your core operations, and they probably had some element of synergies, probably more so from a personnel perspective. I'd love to get your perspective on why you paid for those, and did the fact that they were local and had some strategic thesis lead to a higher valuation?
Yeah, Tom, good question. And then, your thesis and no hypothesis that, in general, a strategic will pay more than a financial sponsor, is probably still true, but I see the lines blurring a lot, certainly with, the bigger financial sponsors, they'll roll things together and roll things up. So they're not, I don't think that's as true as it used to be. To your specific question, the two you mentioned, obviously, we actually the exact opposite of what I said. It's ways like we our core competencies was machining, mostly stainless steel, kind of precision machining, and we had a bunch of some good suppliers around the country, mostly around Northeast Ohio, and they were just not able to keep up financially and quality, and so we embarked basically on an insourcing for a lot of reasons. Those two suppliers were almost captive. One was almost 100% captive. The other was maybe 60. So we actually did not buy them for their intellectual property, because they actually were we had the intellectual property. So we bought those really for diversity in labor force. But they were not in our exact market, machinery and a little bit of know-how, I would say. But those valuations were looked at a very different way than a traditional multiple of earnings approach.
And often the acquisition of talent, particularly in this labor-starved market right now, is not to be underestimated as a rationale for acquisition, for sure.
Yeah, trained workforce was it really helped us as we were expanding. It really helped us tap into two different markets. One in Mansfield, one in Strongsville.
The other part of that, kind of goes to fit, Mark. And I know you guys done a lot of acquisitions at a platform level and then a strategic add-on to that. If you maybe can elaborate a little bit on how that add-on acquisition process is important to you and some of the synergies that you think that you pull together in a second and third acquisitions rather than the platform.
Yeah, I'll give you a good case study. It's actually a Michigan-based company, and company in Grand Rapids. And I guess I can say, I don't mind saying, it's on our website, Action Fabricators. And Action was a converter of flexible materials. So think 3M tapes and adhesives. They had a lot of in-market applications in automotive OEM. A lot of different platforms, no customer concentration, no platform concentration, but they did have OEM automotive concentration, which, candidly is it's not a sexy market. People perceive it as somewhat cyclical in nature, and they probably sold 70% of their products into that market. They had a little small piece of a medical division that did, again, some converting of flexible materials, serving a totally different end market. In our diligence process, we debated about actually selling that, getting out of the business. But the more we looked at it, it was a fairly profitable business. And so essentially we went into Action Fabricators with a thesis of continuing the automotive business, but diluting it somewhat by pursuing strategic add-on acquisitions in the medical space. So we actually hired a third-party investment banker, did a buy-side search. And it's always interesting when you go through those processes. Management teams, they think they know everybody in the industry, right? They think they've been around for 20 years. They know all the players. Well, it turns out the first medical-related acquisition we did, which was transformative in nature, they had no idea who this company was. They'd never heard of it. It was a company based in Nashville that strategically was a fit by what they were, by their processes. Ultimately, we went on to acquire 3 medical-related businesses. And by the time we exited the company a few years later, the automotive exposure of the company was less than 50%, probably closer to 40%. And so not only did we dilute the automotive concentration, but we were also able to grow a part of the business that it did have the perception of a sexier, higher margin, higher growth potential in the medical arena. And so the stars, they don't always line up like that, right? When you do add-on acquisition searches, the most common answer a business owner will give you is, no, I'm not for sale. And so we were very fortunate to identify these 3 add-on acquisitions, integrate them, and ultimately it allowed us to double the EBITDA of the company in 3 years, basically. So it was not only did we increase the valuation from an earnings perspective, we increased it from a multiple arbitrage. We had several turns of positive multiple arbitrage upon exit. So it was a win-win, and the management team did a phenomenal job. Back to your original question to me, they did a phenomenal job of integrating these businesses such that it was not a collection of companies. It was a consolidated entity that went to a couple of different markets, but they all made sense together strategically.
And that's a fantastic case study, and it highlights one of the most important elements of valuation, right? An automotive-centric business sometimes doesn't get a premium valuation, but maybe a medical company does. You find a niche and a capability, and you transform a concentrated position, i.e. too much of one particular industry or two particular customers, right? And now you've transformed it into a medical company that had a whole different profile, and it's a demand for those types of companies is so much stronger and so much more attractive, particularly with a well-built management team, that I'm not surprised you got both EBITDA growth and multiple growth. Fantastic.
Thank you.
Back to our thesis as we begin to define who you go out to the marketplace to and why you approach it. In our world, there's often an allure to having an international thesis where somebody from overseas can buy the business, expand the markets from which they're selling, take your products to the different territories. Art, you've had the opportunity to make acquisitions on an international basis. RHPS in the Netherlands being an example of a regulator business that you purchased. Love to get your insights on, is there truly a multiplier effect to you as a strategic acquirer, and what's the elements of that premium that gets paid because of it?
Yeah, well, so if you look at at Swagelok, past life here, we typically grew either geographic expansion or new products to existing customers, and of course, market share. But that has its limits. Over time, there's just so much that people are going to let you have. So we would always try to break down. We'd always be doing make and buy analysis. Basically, can our engineers spend the time to develop the product and take it to market, or is it better to acquire it? And what we really found out is that we were really good at innovation, and we were really good at taking a product and making it manufacturable. But we probably needed some improvement in that initial market entry. So what we did is we wound up buying a bunch of companies that were a little bit smaller, but were able to leverage their existing platform of products, maybe improve them somewhat, make them more manufacturable, and then take them worldwide, because we pretty much sold everywhere a U.S. company was allowed to sell. Like I said, the sales were about 60% outside the U.S. So to that extent, that acquisition was very successful. We already had another line of regulators, and these were some accessories and some add-on products that we were able to do. Our business model internationally was the same. We had exclusive independent distributors, geographically based, and that model worked for us pretty much all over the world. Some obviously local market customizations and variations. I would tell people, if they want to expand internationally, first of all, a lot of thought has to go into how. making sure you have the right partners. How are you going to do that? How are you going to get a mind share from from your partner and stuff like that. But it's depending on, of course, the product type and the market you serve. It's pretty fruitful if you're not there, especially as some of the customer bases are really international, and if you're servicing Shell or BP or BASF, they want to be serviced around the world with the same product specs and stuff like that. So yeah, we found that a big part of our success.
Yeah, that's great. And really appreciate you sharing those insights, Art. Those are priceless to the listeners here. The other one very important element that private equity in particular really almost demands and wants to see is a growth thesis. And in our survey, that became back as one of the primary points that were highlighted as to if somebody can grow at a very rapid rate, and we asked them what was that rapid rate. It was determined that north of 10% is a very high, compelling growth rate for the business. But most importantly, it wasn't just organic growth. It was the ability to grow through add-on acquisitions. And so I'd love to get your perspective, both Mark and Art, on that topic as to how important was growth or is growth to you in determining the value that you put on the business.
Would you like me to lead, Tom?
You go first. Absolutely.
Sure. So backing up, when I think about most of our platform acquisitions, we tend to gravitate towards low, moderate organic growth companies in fragmented spaces, such that the addressable universe of strategic add-ons is large. Just as an example, the opposite way, we just passed on a company. It was a nice looking business from a financial profile, high margins, solid, steady Eddie earnings, but it was a very niche product. They had 75% of the market, and we couldn't answer the where do you go with it question. So it was a good bond, it was a good mezzanine investment, but from an equity standpoint, we weren't sure where you go with it. So what most of our platforms are, they tend to be in those fragmented marketplaces where we can address the acquisition question, the where do you go with it question. A couple things to that effect. I'll give you some examples of how we play that thesis out. Oftentimes, we have started doing what we call market maps as part of our diligence. So we'll actually hire a buy-side firm to survey the universe of potential acquisitions candidates and see if our thesis of it's going to be a buy and build type investment, if it plays out. And if there's, I'll make up a number. If there's 10 companies out there that you can buy in the United States, probably not, odds are you probably won't do many acquisitions. If there's 80 or 100, then we get excited. Similarly, I'll give you an example of how we were in a niche business that we had grown through acquisition, but we were concerned that the buyer universe would look at it as too niche. Where could you go with it? So we actually hired a third-party market study firm, and we spent a lot of money on this. They did an exhaustive study to assess, in essence, a market map, and to show that not only was there this core market, and oddly enough, this is another Michigan business in Boyne City, company called Industrial Magnetics. But we had to prove out that there was related markets, there were tangential markets that a buyer could get into. We'll never know how much that six-figure study cost us, but the process went smoothly. The buyer did believe that there were add-on acquisitions out there, and it turned out to be a very good investment. So those are a couple of ways that we're validating the thesis, because I totally agree with you. If we can't grow the company, we're not going to have the positive multiple arbitrage that I talked about earlier with Action Fabricators.
That's interesting. So it's actually not the organic growth rate that you're more interested in. It's truly the add-on acquisitions.
It's a little both, but to be perfectly honest, the 25% compound annual growth rate, if you're looking at that type of company, the multiples for those businesses in this market they're extremely high right now. So we tend to, again, gravitate towards the low, moderate growth rate.
And how about your perspective on that, Art? I mean, obviously you've got it from both a strategic and a private equity perspective.
Yeah, as an operator, let me just, for every company, I'm involved in now, whatever the industry, I'm kind of keenly focused on operating leverage, right? And I'm always looking at a dollar increase in sales. How much of that is going to the bottom line? Because most companies, have a pretty good base of fixed cost, right? So organic growth is kind of the flywheel that makes a lot of things happen, and not only drives the bottom line, but it gives you capital to invest. It gives you a higher return, et cetera, et cetera. So productivity, squeezing out productivity and driving top line revenue growth is kind of a CEO's job. Keenly focused on that. And you study it over time, markets tend to grow at inflationary rates, 3%. So we always thought it was pretty good if you could double that, market, China, like when we first got into China, obviously big exception, but, in general, that's what we tried for. So, that was definitely the business thesis we were trying to push towards, is we have to do twice as good as just the rising tide floating all boats. On the strategic side, definitely more interesting, interesting perspective. Typically from MCM's perspective, since they tend to buy smaller manufacturing companies, you can envision, if you put some elbow power and horsepower behind marketing and some strategic stuff, you should be able to do pretty good on the growth side and stuff like that. Obviously, the larger sponsors, they have to have a different thesis and stuff like that. But I think growth. First of all, it helps with multiple expansion and profit, so you get the double bang, right? More profit and more multiple. But if you don't have it in an organization, it really limits your ability to reinvest and do different things. So I think first and foremost, it's a business imperative before it's an M&A imperative.
Yeah, I think that's right. And kind of related to that is the concept of scalability and the operating leverage systems you talked about, Art. From your perspective, Art, how valuable is it to see that they've got an IT infrastructure, they've got an ERP system, they've got systems and processes to allow the business to scale? Is that an important factor?
With the cloud, I find that depending on what they're on, but with the cloud now, scalability is not the challenge it once was. If people have migrated to one of the gazillion cloud systems out there, so I don't know that IT is as big as, obviously they have to have a system, and everybody's laser focused on cyber. But with the cloud, and the software as a service, the scalability is kind of built in, which is kind of nice. But we look at, on an acquisition front is, first of all, the physical assets, right? And then it's amazing. We had a philosophy at Swagelok to heavily utilize our equipment. So we spent a lot of time on the right shifting strategy. I find many manufacturers kind of are one shift manufacturers, or shift and a half, or shift with overtime. And as a result, will buy capital before they'll put on second and third shifts. That is not my inherent philosophy typically. So it's something I usually try to get a handle on and try to find out why that would be. I know the pros and cons of it, but I'm heavy on asset utilization. So anyway, those are some of the things I look for.
That's great. And so, Mark, if you took the concept of scalability and you applied it to process, and I know a lot of people use an EOS, entrepreneur operating system, as a platform for just people working together. How is your view of that scalability, interactivity of management team?
It's interesting. I'll go back to my comments about not having always a complete management team, and I think this is another example of what you get in a lot of lower middle market businesses. Not always, but we oftentimes, when we go into these companies, we go in it with eyes wide open that we're absolutely going to have to invest to make the business scalable. And whether that be systems, whether that be people, whether that be physical plant, all it's just not a neatly buttoned up box in a $4 or $5 million EBITDA business for sure. So I think what we have to do as investors, and we ultimately answer to our limited partners, is we have to move quickly to make those investments early so that the pieces are in place such that it is scalable, that you can do add-on acquisitions, and that one day it's an attractive property to both financial and strategic buyers. So it's really just inherent in lower middle market businesses.
Now, that's great. And of course, every business owner that's sitting out here listening to it, boy, I can't wait to fix up my business, make it perfect. I'm going to spend 2 years and do this and wait for all the tides to be perfectly aligned. And it just never happens, right? So if you had to give, advice to the friend sitting across the screen from you, what would you tell them as they prepare for getting ready with the aspiration of getting a premium value? What would be your advice, Art?
Well, Tom, if you go back to, I know I'm older than you and probably older than Mark, but this idea of quality of earnings, 30 years ago, that I don't know where that term was, but it drives me crazy, all these adjustments, to normalize earnings. I mean, obviously some of it makes a lot of sense. You have a fire and you get a big settlement, et cetera, et cetera. But I see too many people waiting to the last minute to dress things up. I would say, from both a strategic and a sponsor buyer, the more you're running to the state that you're the end state, the better you are. If you got to the end state in the last 3 weeks, that doesn't bode very well, in my opinion, with 15 add back adjustments, because we really were meant to do this and we really meant to do that. So I think the more you can tune your business ahead of time and not wait for the last minute. We had an adage when I led the company is, why should we ever let anybody else do something that we can do? And if we could have the financial wherewithal and the courage to make a decision, we should do it. We shouldn't let somebody else do it. So my advice would be, don't wait.
So you're telling me to not optimize my taxes and to run it for full profit. Is that the?
Well, that's a different thing, but I'm talking about redundancies and getting cost out and doing those type of things.
How about you, Mark? Same question, different.
Yeah, I totally agree with what Art said. I mean, selling a business is a point in time, kind of like a balance sheet. But leading up to that process is kind of more like the income statement. It takes in a period of time. And we actually we have a platform now. It's a neat little business called Quick Serve. We just closed on an add-on acquisition. But Quick Serve manufactures transaction windows. They're big. They're big with fast food restaurants. They're exclusive with Chick-fil-A and a number of other restaurants. And that's a company that there's been a lot more drive-throughs during COVID, obviously. But our CEO there really did a smart thing, and probably 2 or 3 years, I think 3 years before selling, he actually retained a consulting firm that he had been referred to by his accountant, I believe. And they worked with him to address kind of the things that Art was mentioning. Any weaknesses in the business, they worked with him to address. He didn't get them all done, obviously, and there's capital limitations, but he got a lot of them done, such that when he hired his investment bank and went to market, it was obvious that it was a pretty solid company with a path to growth, with no huge impediments to growth, and it did secure him a pretty nice valuation. And I know there's certain, I'll put a plug in for you. Somebody like you, Tom, would probably be a great resource for a business owner, 2 or 3 years in advance of the sale process, to address what people are going to see as a weakness, and ultimately it's going to detract from the valuation. One common thing that we see oftentimes is it's a good company, but all the assets are walking out the door at closing. It's a very small management team. Succession is not addressed. And candidly, our letterhead says investments with management. That's the absolute opposite. We're not investing with anybody. And so it probably lends itself more to a strategic acquisition. So therefore, you're limiting the buyer universe.
And it happens a lot. Someone's not willing to write the check for that manager that fills in some of the relationship gaps that you might have. But we end up finding we get a turn and a half higher, usually with really high quality management teams. So, right to your point. One of the really interesting things that we asked in the survey was, I'll call it a little bit of a self-serving question. We asked 3 questions. We said, Mark, you as a private equity buyer, do you have a higher sense of certainty selling your business with an investment banker? 93% said they had a higher sense of certainty. Okay, so that was not so surprising. 75% that they said that they were going to pay a higher price knowingly if an investment banker was involved. And then 69% of the people, despite knowing that they're going to pay a higher price, and these are serial acquirers, said they would love to have the business represented by a high quality investment banking firm. I found that to be absolutely fascinating. And again, it's a self-serving question, but Mark and Art, from your perspective, what is the value of an investment banker in securing a premium valuation? I'd love to get your angle on that.
Well, I'd say a few things. There's the obvious, auction-related process, but that aside, I think somebody like your firm, Tom, if you really understand the industry, you understand who to go to, you understand how to help them put the sales document together. I think that's usually value. I'm sure most business owners would have a tough time putting together their own sales documentation. I think Mark's idea is totally excellent, that, really going back to don't wait till the last minute. You really should be having dialogues a year or 2 before you want to sell with somebody, not only to optimize the business, but to just talk about how to market it, how to portray it. Now that I'm, doing a little bit of work on the private equity side, I read way more of these than I ever did. And, you can tell the good ones from the bad pretty easily. And then if you read a bad one, it's kind of hard to know, is it a bad presentation or a bad business? And so you got to do a little bit more digging. So I think it's pretty invaluable to really have the right representation and really have them help you think about who would be who would be the best holder of this asset.
That's great insight. And how about you, Mark?
I'll echo that, and I'll say the potential buyer universe out there has grown tremendously, and whether that's financial buyers, there's probably, you would know better than I would, Tom, but I bet you there's 2,500 private equity groups out there, and that doesn't even probably more, and that doesn't even include all the emerging class of family offices. There's the strategic angle, so we would never be able to guess the buyer of our companies going into a process. Then there's the process itself. It's exhaustive to prepare for something like that. The level of diligence that the investment banks do, and candidly, the good ones, the positioning, the message that they create to make it appealing. And it starts with a teaser. It goes into the executive summary. I mean, this. There's a lot of work to be done in how to position that asset in the best possible light. The flip side of it, from our perspective, when we're buying a company, there's some benefits to buying a company that's not represented. You might pay a little less, but ultimately, it doesn't take many to generate kind of competitive fever. And the negative, obviously, is it can be like pulling teeth, getting information. Diligence issues pop up. There might not be commitment on the part of the seller. He's not written an investment bank a retainer check. And a week before closing, after we've invested substantial time and money, it could change his mind. So it's a delicate balance between buying a represented versus an unrepresented. I'll tell you this. Of certainly all of our platforms, 90+% have been represented by some type of intermediary. And on our exits, 90+% of the time, we have an investment bank represent us. So they're very well utilized in our world.
Yeah, I think Mark hit the nail right on the head. The other, just add one little thing is, oftentimes if a owner seller, he doesn't know what's normal. So, you find out you ask for a simple due diligence request, and they think it's a trust issue, and it's often not. So I think really helps to just kind of tell them, no, this is this is down the middle. This is pretty typical, kind of calming their nerves.
The one thing that I would add to that, I agree, Art, is the sellers, they need to have an experienced M&A attorney. And I know Tom knows this, but not every attorney is created equal. And we have certainly dealt with people that don't know what market conditions are. They don't know about reps and warranty insurance and caps and baskets. What is acceptable, and that can become very problematic.
And I'll appreciate all those comments. I think they're dead on. I think the part of what you're saying is you're going on a very significant journey to sell your business. You're desiring a premium valuation, and there are 5,000, 10,000 financial buyers, SPACs, now creating one a week, right? You have to have a navigator for it. It's the reason why professional firms like yours, hire an investment banker to sell their business. I would encourage you to prepare in advance. I'd encourage you to have dialogues with people that are informed, and begin to understand really the drivers of what gives you that premium valuation and when. The other part we haven't talked at all about today is the discussion of timing. Not all times are created equal. We're sitting in a very unique time where capital gains rates are talked about going up 20%. Highly encourage you to consider evaluating, the landscape of timing and how that impacts your business as well. I'm getting the buzzer ring here, says that we are heading off to the live Q&A and exceeded our time. Art, Mark, can't tell you how much I appreciate all your insight and look forward to a live, active discussion.